Regulating decentralized finance, opportunities and challenges. Decentralized finance or DeFi is rapidly transforming the landscape of the global financial system. Built on blockchain technology, DeFi enables peer-to-peer financial transactions and services without the need for traditional financial intermediaries like banks, brokers, or payment processors. This promise of greater accessibility, transparency, and efficiency, DeFi has gained significant attention in recent years, attracting billions of dollars in investments and user engagement. However, the rise of DeFi also brings significant regulatory challenges. In this article, we'll explore the opportunities and challenges of regulating decentralized finance and how governments and regulators are grappling with this rapidly evolving space. What is DeFi? DeFi refers to a set of financial services and applications that run on blockchain networks, primarily Ethereum, and are powered by smart contracts. These services allow users to engage in activities such as lending, borrowing, trading, insurance, and asset management without relying on centralized financial institutions. By removing intermediaries, DeFi offers users greater control over their financial transactions, faster settlement times, lower costs, and a more inclusive financial ecosystem. The decentralization aspect also means that services are accessible globally without being restricted by national borders or regulatory frameworks. The rapid growth of DeFi is reshaping the financial industry, prompting regulators to question how traditional financial rules should be applied to this decentralized model. As DeFi continues to expand, it's essential to balance innovation with the need for consumer protection and market stability. Regulatory opportunities in DeFi. Regulating DeFi offers several opportunities for governments and financial institutions, especially as the sector grows and becomes more integrated into the global financial system. Some of the key opportunities include financial inclusion. One of the main benefits of DeFi is its potential to promote financial inclusion. By eliminating traditional financial intermediaries, DeFi provides access to financial services for individuals who are unbanked or underbanked. Regulatory frameworks can help ensure that these services are secure, transparent, and accessible to a broader audience, especially in developing countries where traditional banking services may be limited. Innovation and growth. Proper regulation can foster innovation by providing a clear legal framework for DeFi projects. When companies and startups are confident that they are operating within a regulated environment, they are more likely to invest in the space and build innovative solutions. Regulation can also attract institutional investors who might be hesitant to engage in DeFi due to concerns over legal uncertainty. Market stability. DeFi's rapid growth has led to concerns about market volatility, especially in areas such as yield farming, decentralized exchanges, and governance tokens. Through regulation, authorities can implement measures to reduce risks and protect investors from excessive speculation, fraud, and market manipulation. A balanced regulatory approach can ensure that DeFi continues to grow while minimizing the potential for harmful bubbles or crashes. Regulatory challenges in DeFi. While there are opportunities, regulating DeFi also presents numerous challenges due to the unique characteristics of decentralized systems. Some of the most significant challenges include lack of centralized control. Unlike traditional financial institutions, DeFi platforms are decentralized and do not have a central authority. This makes it difficult for regulators to hold any single entity accountable for misconduct or illegal activities. In traditional finance, regulators can target specific institutions such as banks or exchanges, but in the world of DeFi, responsibility is often distributed across multiple nodes or smart contracts. This decentralized nature complicates enforcement and raises questions about jurisdiction. Anonymity and privacy. Many DeFi platforms prioritize user privacy and anonymity. While this is an advantage for users who wish to protect their personal information, it also makes it difficult for regulators to track and monitor transactions for compliance with anti-money laundering and know your customer regulations. DeFi applications often use pseudonymous addresses, making it challenging to link transactions to specific individuals or entities. This creates potential risks for illicit activities such as money laundering or terrorist financing. Cross-border issues. DeFi platforms operate globally, transcending national borders. This introduces challenges for regulators, as each country may have different financial regulations, tax laws, and standards for consumer protection. It becomes difficult to enforce national regulations when DeFi transactions occur across jurisdictions with varying legal frameworks. Global cooperation among regulators may be necessary to address these cross-border issues, but this requires alignment of legal standards and coordinated international efforts. Smart contract vulnerabilities. DeFi platforms rely heavily on smart contracts, which are self-executing agreements coded in the blockchain. While some contracts provide automation and security, they are also vulnerable to bugs, coding errors, and exploitation by malicious actors. A flaw in a smart contract can result in significant financial losses for users. Regulators must consider how to address the risks associated with smart contract security, including mandatory audits and certification processes. Unclear legal definitions. The rapidly evolving nature of DeFi creates uncertainty about how existing laws apply to decentralized financial services. For example, questions arise regarding whether DeFi tokens should be classified as securities or commodities, or whether DeFi lending platforms should be subject to banking regulations. As DeFi evolves, regulators must create clear legal definitions to guide compliance and enforcement. Proposed regulatory approaches. As DeFi grows, various governments and financial regulators are exploring ways to create regulatory frameworks that support innovation while protecting consumers and ensuring market integrity. Some proposed regulatory approaches include defining clear legal frameworks. Regulators need to establish clear legal definitions for DeFi activities and determine how existing laws should apply. For example, defining whether DeFi protocols are considered securities, commodities, or financial products will help establish the rules for market conduct, disclosure requirements, and investor protection. Some jurisdictions like the U.S. Securities and Exchange Commission are already exploring how existing securities laws apply to DeFi projects. AML and KYC regulations. To combat illicit activities, regulators may require DeFi platforms to implement anti-money laundering or AML and know your customer or KYC procedures. This could involve obligating decentralized platforms to partner with identity verification providers or using decentralized identity solutions to ensure that users are not engaging in illegal transactions. While this could reduce privacy, it may be necessary for ensuring that DeFi platforms operate legally and transparently. Smart contract auditing and certification. One possible approach is to require DeFi projects to undergo third-party audits and certification of their smart contracts to ensure they are secure and free of vulnerabilities. Regulators could set up a framework that mandates regular security assessments and reviews of smart contracts before they are deployed. This would reduce the risks associated with smart contracts, bugs, and exploits, providing a safer environment for users. Decentralized governance and regulation. One of the unique aspects of DeFi is its decentralized governance model, where token holders participate in decision-making processes regarding platform upgrades and policies. Regulators could explore the possibility of working with DeFi projects to develop decentralized regulatory frameworks, allowing communities to set self-regulatory standards and monitor compliance. This would align with the decentralized ethos of DeFi while promoting greater accountability. Case studies of DeFi regulation. Some jurisdictions have already begun experimenting with DeFi regulation. European Union. The European Union is actively working on regulatory measures for DeFi as part of its broader digital finance strategy. The EU's proposed markets in crypto assets regulation aims to provide legal clarity on the treatment of digital assets, including DeFi tokens. Markets in crypto assets would create a regulatory framework for cryptocurrencies and DeFi activities, establishing clear rules for transparency, market integrity, and consumer protection. United States. In the US, regulators such as the SEC and the Commodity Futures Trading Commission are considering how DeFi fits within existing securities laws. The SEC has hinted that certain DeFi tokens and platforms may fall under securities regulations, especially if they resemble traditional financial instruments like stocks or bonds.